Have you ever gotten a letter from the IRS that says you owe them penalties and interest? What?
And you think there's nothing you can do, so you just pay it?
Hey now, there's ways of getting around penalties and interest, and it has to do with a fancy term. What's that term, Mike?
Reasonable cause. But what's reasonable, Josh?
Is it about what a reasonable person would do? No, we're dealing with the IRS. Let's get real. It's not what a reasonable person would decide with another reasonable person. It has to do with some specific techniques and language to add. So let's give some examples of penalties and interest that people might get. Mike, how have you seen penalties and interest impact people?
Well, let's say the IRS sends out a CP 2000 notice. You forgot to report down stock sales you had, and now you owe the IRS $5,000 in tax, but another $6,000 in penalties and interest.
That starts with the 6662, disregard for the law, intentional disregard for the law. They're going to throw 20% on top of it if the difference between what you say and what the IRS says is the lesser of 5,000 or 10%. That 10% is a tricky number. So you have 20% added on as a penalty. Interest is on top of that. And according to the Internal Revenue Code, which is the law of the land, there's no way that you can take the butter and the chocolate chips out of a cookie. There's no way you can take the interest and the penalties away. It's all considered tax.
So we have the ability to pay the $5,000 in tax. There's no doubt about it that we determined that we have that ability. And we might even have the ability to pay the extra $6,600 the IRS is charging us for reasonable cause. Well, that tax we're going to have to pay no matter what. But Josh and I are going to walk you through the steps and talk about a reasonable cause abatement.
You as a taxpayer have the right to exercise reasonable cause, but reasonable cause has a lot that it has to hinge upon. It's like a three-legged stool. You need three things that you need to cite if you're going to challenge something based on reasonable cause. You're going to want to look at the Internal Revenue Manual, which is basically their Bible, their code of operations. When they look at things, they look to the manual. And so you have a direct Internal Revenue Manual cited.
You have to look at the tax code too itself. The tax code is exactly what was written into legislation. It was written by the House of Representatives, the Senate, passed by the others, signed by the President. This is the tax code, and that is the law of the land.
And as per our U.S. Constitution, all tax code starts in the House Ways and Means Committee, goes to the Law House, goes to the Senate, and then to the person who sits in the executive office. This is found in Title 26. It's called the Internal Revenue Code. And the third basis that you're going to have, that third leg in your stool to have a stand that's sturdy, is U.S. tax court decisions that really reference exactly your position, your situation, the circumstances and facts align with your own, and you use that to support your own reasonable cause argument.
So Josh and I are going to walk you through what should be in a reasonable cause letter and what should accompany that reasonable cause letter. And we're also going to talk about situations where reasonable cause is likely to get approved and where reasonable cause is likely to get squashed before they even open up the envelope.
The whole idea is we want to help you address your tax situation on your own, to look at those penalties and interest and how much of that you can nitpick like raspberries and take it away, rather than have to pay the entire amount to the IRS. Remember, this is all here for educational purposes. It's not intended to really hold your hand and guide you through the whole process. So Mike, with that?
Sure. So let's talk about an example where reasonable cause would work. Take someone through that.
So let's say you've got a situation where you've got a W-2 that was not filed with the IRS. And this is 2021. That's called a closed tax year. It's more than the current year plus 2 years back. We're currently in 2025, so 2024 is the current tax year. 2023 and 2022 are the 2 years prior. 2021 is a year that you can't even amend. The IRS isn't going to look at it, so you can't fix that. But if you hadn't filed that return, that means you can still file it and it would be considered a current tax year. The W-2 is a tax form, so you file that, but the IRS has asserted something. The IRS has asserted that you didn't file it, so there's penalties for negligence or disregard for the law. There's a 20% add-on for that. There's a 6651A1 failure to file, and there's a 6651A2 failure to pay. All of these penalties add up to $103,000, and that's on top of the $500,000 that you owe for not paying the tax.
So I decided I don't want to pay penalties and interest like that because it really wasn't my fault that I owe it. So I'm going to write a reasonable cause letter. When I write that reasonable cause letter, I'm going to cite things in tax court cases that support my request. I'm also going to cite the IRS's Internal Revenue Manual, which is what these revenue officers and revenue agents are supposed to follow, and I'm going to cite the legislation itself. But I'm not only going to write a letter, there's something else that needs to accompany that letter that is a crucial piece.
And when you're looking at that letter, they're going to put in the mail certified, because when you certify it, you have it so that it's a little more formal, but it's a way of putting it in front of the IRS so that they know what to talk about. Mike, I didn't even answer your question. When you're looking at this, the other thing that you're going to want to put in there, not just your letter that's going to cite the Internal Revenue Manual, the Internal Revenue Code, and U.S. tax court decisions, you're going to have your evidence, your supporting documents, your substantiation for your position, the documents that you have in your possession that the IRS kindly doesn't have them. And you're going to say, please lovingly look at this information and wipe away those penalties and interest.
And why do we have to include that? Why don't they just believe us?
Well, there's a thing about the IRS. They have three favorite words that are not necessarily the same favorite three words that you give your loved ones that they give you. They're all liars is kind of their three words. So if they're thinking that you're probably trying to jimmy the system, they're not going to believe you unless you have substantiation, proof, documents that support your case in terms of evidence.
So now we write a letter, and the letter is perfect, and we attach all the supporting documentation. But the IRS writes us back, and the IRS says, too bad, so sad, you still owe it. Is it done there, or do we have another option?
It's not done there. So you're going to get this letter back from the IRS, and they're going to give you a short, small little window of opportunity to file a case with appeals, the Independent Office of Appeals, to have them take a look at it. It's independent from two things: IRS collections and IRS examination. So you can take a look at that appeals hearing and present the same evidence and maybe even come with a totally different outcome.
Now, why it's so important to attach the supporting documentation and have your letter written correctly is because the appeals officer that gets that technically should not be looking at any new evidence. So let's say we wrote the letter, but we didn't attach the supporting documentation. Well, that revenue officer or revenue agent made that decision, made the decision correctly. Now, sometimes they will look at new evidence, or sometimes we give them supporting documentation and they'll return it back to the person who denied it. But many times, especially with the overflow of work case the IRS has right now, if it doesn't all seem to be substantiated in one concise package in your original filing, they're going to deny this, and the appeals officers then want to deny it too as well right away.
Exactly.
And then you owe it.
Yeah, well, then the appeals officer is going to write you a document that's going to say, too bad, so sad, sorry. At the bottom, read the fine print, because you have the opportunity to file a U.S. tax court petition. When you file a U.S. tax court petition, now, we're not saying anything about that appeals guy or that examiner guy, if it's a revenue agent or a revenue officer on the exam, or if it's a tax compliance officer at ACS. But if you're dealing with the revenue agent, they've got a lot of talent. That person in appeals has got even more talent. And if you swing and miss and strike out in appeals and you file a U.S. tax court decision, boy, they're going to put you into the U.S. tax court. But before that, they say, hey, you know what? This is kind of expensive for us and you. What say we go in the side door to appeals and we talk with an appellate officer? Now, if you want talent, you want somebody who's got 30, 40 years at the IRS, like Herb Cantor, our colleague, this is the person you're going to be dealing with. This person has seen it all and then some. And this is the person you want to be in front of when you present your reasonable cause argument with your Internal Revenue Manual sightings, your Internal Revenue Code sightings, your U.S. tax court sightings, and your substantiation, backing up everything that you said.
So bottom line is we get 3 swings at the plate on this one. 3 swings to go and hit this out of the park and to get that reasonable cause approved. And a lot of times you think tax court, off the top of your head, you say that's the hardest one to win. Many times it's the easiest one to win because you could be dealing with a very difficult person who initially has that letter. You could then be dealing with an appeals officer that is strict by the book. But when we go to tax court, as Josh said, the IRS has to look at their hazards of litigation. They're paying very expensive attorneys. They're not cheap, right? Nope. They don't work for poverty, right? Nope. Very expensive people.
So when you're looking at the U.S. tax court and you get in front of an appellate officer, you got to think about this in terms of burden of proof. It's on the IRS's side to prove your case for a U.S. tax court judge. And it goes like this. The burden of proof is based on a preponderance of the evidence. Your standard of proof is basically a 49 to 51% little, what do we call it, teeter-totter. Because when you look at the amount that you owe the IRS, if that appellate officer thinks the case is weighted more heavily in your case, he's going to give you 51% or greater on your side. That's a hint that you might win in tax court. However, that revenue officer or revenue agent who examined your return is looking at things in terms of beyond a reasonable doubt, which is not the position of the U.S. taxer, the highest level of challenging the IRS. Neither is at a level where they're based on facts and circumstances, which is more of a 75%, 25% thinking through the truth. It's 51-49 in U.S. tax court. So if you're going to go to the third level and challenge things in tax court, things are definitely more on your side.
Now, something we're going to talk about is a special treat. We're going to give you some examples where reasonable cause worked and where reasonable cause won't work. Josh, tell me about an example where reasonable cause does work.
Reasonable cause works when the IRS establishes the penalty and interest based on the sale of a primary residence. I had a client who lost his wife, sold the property, and never filed his tax returns. That 1099-S that the county gets for the sale of the residential property got sent to the IRS. So he owed somewhere over $243,000. He didn't owe that really. We just had to file the tax return, and then we had to submit it to the appeals officer to be able to examine it. So we had to go for the second swing, but we got it through.
Here's an example where it never works. It never works when you're habitual. So you don't file tax returns for 4 years in a row, and the IRS assesses late filing penalties, late filing interest. Unless there was something that you were in a coma and someone else is now filing these tax returns on your behalf, but pretty much short of that, they're just going to say you're habitual, and even if it was a great reason for 1 year, they're going to give it to you for no years.
And Mike brought up an interesting point. That's another reasonable cause. When you're looking at reasonable cause, medical reasons, the C word, cancer, can also play a role. So if there's an episode of cancer in the family, or you have cancer and it really holds you back from fulfilling your requirements to file your taxes, that is a reasonable cause, as well as a death of an immediate family member. It can't be your uncle because that's a little too distant, but there are other reasonable causes that you don't necessarily have to cite the code and the law and tax court cases, but you do have to have that substantial proof in terms of death certificate and the obituary listing.
Here's an example of where it doesn't work. You give all your tax documents to a tax practitioner and file your return, but the tax practitioner does not file your tax return. You never sign anything, it never gets filed, and now you owe late penalties and interest or many other types of penalties and interest on this return. Ultimately, it's your responsibility to file that tax return on time. So if you don't do it and you know your stuff is sitting in a practitioner's office and that return didn't get filed timely, you owe that tax. You're ultimately responsible for it.
But in the same breath, I'm going to say there are ways for you to take that filing. So say it's a W-2, you've given all the information to the professional tax preparer to do the work, and then they didn't do the work, and they were waiting on something, but I didn't do it. If you get a notice of deficiency, a statutory notice of deficiency from the IRS on this issue, that is a doorway into filing a U.S. tax court petition and challenging that negligence or disregard for the law, failure to file, and failure to pay penalties, and poof, it can all be gone. So reasonable cause has lots of flavors, But one thing is true, you have 3 swings at the plate.
My name's Mike Bellacci. I'm with Fink Harbor CPA.
I'm Josh Lubskowski with Best Tax Pro. I hope this has been enjoyable. Please reach out to somebody who can really benefit from this, and make sure to smack that like and subscribe buttons and let us know what you think about it in the comments below.